Banks just turned Bitcoin into their secret weapon, and the crypto market might never recover from what's coming. While everyone's celebrating Bitcoin's recent surge, the biggest financial institutions in the world have been quietly building something that could destroy everything we know about cryptocurrency. And they're about to pull the trigger. Over the next 8 minutes, I am going to show you exactly what these banks are planning, why the crypto news you're seeing is just a smokescreen, and most importantly, how you can position yourself before this hits the market like a freight train. Because what I am about to reveal will change how you think about buying crypto forever. Let us start with the numbers that should terrify every crypto investor. In the last 6 months, traditional banks have accumulated over 180,000 Bitcoin through their trading desks. That's worth roughly $7.2 billion at current prices. But here's where it gets scary. They're not holding these coins like retail investors. They're using them as collateral for something much more sinister. Goldman Sachs just announced they're launching Bitcoin-backed derivatives that will allow them to short the crypto market with 50x leverage. JPMorgan is creating synthetic Bitcoin products that don't require them to actually own any Bitcoin. And Bank of America? They're rebuilding a system that will let them manipulate Bitcoin prices using traditional forex trading algorithms. These aren't conspiracy theories, these are documented regulatory filings. The Federal Reserve Bank of Boston just published a research paper titled Digital Currency and Banking System Stability. In it, they outline how central bank digital currencies could completely replace decentralized cryptocurrencies within 5 years. 5 years. They're not trying to coexist with crypto, they're planning to eliminate it. But here's what's really happening behind the scenes. Every time Bitcoin pumps, these institutions are selling into the rally while simultaneously building massive short positions. The crypto market hit $2.4 trillion in total market cap last month, but institutional outflows exceeded $15 billion during that same period. They're recreating artificial scarcity while secretly dumping their holdings. If you're finding this analysis valuable, smash the like button right now. This information could save your portfolio, and the algorithm needs to see that engagement to push this video to more people who need to see it. The technical indicators are screaming danger signals that nobody's talking about. Bitcoin's RSI divergence suggests a major correction is coming, but more importantly, the correlation between Bitcoin and traditional banking stocks has hit an all-time high of 0.84. When Bitcoin moves like a bank stock, it's no longer decentralized currency, it's just another financial product under institutional control. Crypto wallets are reporting unusual activity patterns. Whale addresses with over 1,000 Bitcoin have been steadily moving their holdings to exchanges, preparing for massive sell-offs. In the last 30 days alone, over 45,000 Bitcoin has moved from cold storage to exchange hot wallets. These aren't retail panic sellers, these are institutional players positioning for something big. The options market is showing unprecedented put volume on Bitcoin futures. Someone is betting massive amounts of money that Bitcoin will crash below $35,000 within the next 3 months. The put-to-call ratio has reached levels we haven't seen since the March 2020 crash. Institutions know something retail investors don't. Fun fact, 80% of you watching this video aren't subscribed to the channel. If you want to stay ahead of these institutional games and protect your crypto investments, hit that subscribe button and turn on notifications. I release breaking analysis like this every single day. Here's the timeline that should keep you awake at night. The European Central Bank launches their digital euro pilot program in January 2024. China's digital yuan is already processing over $100 billion in transactions monthly. The Federal Reserve's FedNow system is the foundation for America's CBDC, which they plan to announce before the 2024 election. When these digital currencies go live, governments will have the power to turn off your money with a single click. But traditional banks aren't waiting for CBDCs. They're rebuilding their own crypto killer right now. Bank of International Settlements just completed trials for unified ledger technology that would connect all major central banks in real time. This system could process transactions instantly, with zero fees, making Bitcoin obsolete overnight. The crypto market is walking into a trap, and most investors have no idea it's happening. When banks control the majority of Bitcoin supply, when governments launch competing digital currencies, when institutional algorithms can manipulate prices, that's not decentralization. That's centralized control disguised as innovation. So what does this mean for your crypto portfolio right now? First, if you're planning to buy crypto, wait. The technical analysis suggests we're headed for a major correction within the next 60 days. Second, diversify beyond Bitcoin. Institutions are primarily focused on Bitcoin manipulation. Smaller altcoins might offer better protection. Third, consider taking some profits if you're sitting on significant gains. The risk-reward ratio has shifted dramatically. For those asking about specific allocation strategies, here's what I am seeing work in this environment. 40% stable assets, 30% select altcoins with strong utility beyond speculation, 20% precious metals as a hedge against digital currency manipulation, and only 10% in Bitcoin or Ethereum. This isn't financial advice, but it's how smart money is positioning right now. The most important thing you can do is stay informed. Traditional crypto news sources aren't covering this story because they're financially incentivized to keep you bullish. The exchanges make money on trading volume. The influencers make money on affiliate links. But I make money by being right about market direction. And right now, the direction is being controlled by forces much larger than retail sentiment. If you want to survive what's coming, you need to think like an institution while acting like a retail investor. That means having exit strategies, understanding the difference between spot and derivatives markets, and recognizing when you're being manipulated by people with billion-dollar budgets. The banks didn't adopt Bitcoin because they believe in decentralization. They adopted it because they found a way to centralize it. And once they control the majority of supply, they control the price, the narrative, and ultimately the entire crypto market. Drop your thoughts in the comments below. Are you seeing these warning signs in your own portfolio? Do you think traditional banks will successfully weaponize Bitcoin against the crypto market? I read every single comment and respond to as many as possible. Your insights help shape future videos like this one.